Okay, so here we work on this company, and this company is U.S. company that has business in two countries and has cash flows denominated in both U.S. dollar and Canadian dollar. So here is a table tells you the income statement, and you can see the cash flows at the end is 207 U.S. dollars and the negative 206 Canadian dollars. And of course, the Canadian dollar could vary at a different rates. So you can see that Canadian dollar can be $0.75, and that makes the sale of $4 there to be 3 US dollar, and 200 Canadian dollar to be 150 US dollar. 10 Canadian dollar can be converted to 7.5 dollar. So based on the U.S. sales, U.S. costs, and U.S. interest expenses, as well as the Canadian sales, Canadian cost, and the Canadian interest expenses, you can combine them all for total sales, the total operating expenses, and total interest expenses, and then you use the total sales minus total operating expenses minus total interest expenses to get the total cash flow in dollar terms, and that combines both American business and Canadian business. You're gonna do the same thing for a different exchange rate of Canadian dollar, and here Canadian dollar is $0.80 per Canadian dollar, and you have a different cash flow in US dollar. And when Canadian dollar appreciates to 0.85, then your dollar cash flow is going to be reduced. Okay, so that's basically the relationship between the Canadian dollar exchange rates and the US dollar cash flows. All right, so one way to reduce the exposure from Canadian dollar here is definitely to reduce the overall cash flow denominated in Canadian dollar. Right here, you have a negative 206 Canadian dollars. So if Canadian dollar appreciates, you ended up paying more US dollar for the same amount of 206 Canadian dollar. So that's something you definitely want to avoid. So what you can do here is to increase the exports in addition to investments. So you increase the foreign sales. You try to make more sales in terms of Canadian dollar and reduce the operating costs in Canada. So you pay less Canadian dollars to the foreign subsidiaries. And also you reduce the foreign financial cost. You raise less capital from foreign sources, so you pay less interest, less dividends in Canadian dollars. And you also stabilize the earnings in Canadian dollar. Okay, that help you put less discount on the cash flows. Okay. Well, the thing is, the domestic operation could also be affected if you increase the export to the foreign country. Then the domestic sales would suffer, and if you try to reduce the foreign operating costs, the domestic cost will increase because you try to shift the production from overseas to domestic. Okay, and right here we have a comparison of the proposed structure I just mentioned. So right here in this column, you have the proposed structure. So Canadian dollar sales is increased from the original structure, which is in this column. The original sales was 4 Canadian dollar, it raised to 20, and the cost was 200 Canadian dollar, now it reduced to 100, and the interest expense was 10 Canadian dollar, now it's reduced to 5. And you can also see that the U.S. costs is increased from 50 to 140, and the U.S. interest expenses also increased. So that means the U.S. business is also affected. All right, so we can compare the proposed structure versus the original structure and compare the cash flows for the Canadian dollar rates at 0.75, 0.80, and 0.85. All right, and you will have different values in the proposed structure. Here's 47.25, here's the 43, here's the 38.75. And right here, I put the data on a chart. The vertical axis stands for the cash flows, okay, denominated in US dollar, which combines both American business and Canadian business. And the horizontal axis represents the exchange rates of Canadian dollars. Okay, So here are the values of Canadian dollars in the case. The original structure is denominated in the downward sloping blue solid line, and you can see the slope is actually pretty steep. All right, and after we done the proposed structure, what you'll see here is after the cash flows in Canadian dollar is reduced by increasing sales and reducing the cost. So there's a less cash flow in Canadian dollar and a less exposure in Canadian dollars. So the exchange rates of a Canadian dollar could affect the cash flow by less amount. So basically you see this right solid line is flatter. So that means the cash flows is less sensitive to the change of exchange rates. Okay, if you compare the blue line and the red line, definitely the red line is flat. So basically, if the exchange rates go up by a lot, there's not very much change in the cash flow for the red line versus the blue line. So that's the whole idea of it. We try to reduce the cash flow denominated in foreign currency. At the end of the day, we will see that the slope of the economic exposure, the slope basically represents economic exposure, or the sensitivity of cash flows to exchange rates becomes lower, okay, or the line becomes flatter, or the economic exposure becomes less. All right, so how do we measure economic exposure? So in your homework, I have already showed you, we just use the Excel function to get slope. And that slope is basically a multiplier of the exchange rates in response to the cash flows in dollar terms. Or you can call it the sensitivity of the future home currencies values in the assets and liabilities to random changes in exchange rates. So that's the economic exposure in a book value term. In book value term, we use the firm assets and liabilities in the balance sheet to represent the firm's value. And right here, the economic exposure can also be called sensitivity of the firm's operating cash flows to random changes in exchange rates. So the operating cash flows here brings the market value of the firm. If the firm is able to generate more operating cash flows, so definitely it's worth more to the shareholders. And that's how the market value is computed, all right? So anyways, the economic exposure is a sensitivity of a dollar figure in response to the exchange rates to foreign exchange. Okay. So right here we have this formula. P is the dollar value equals to A plus B times S, and this is the easiest regression model. So we have an intercept term, we have a multiplier. A is the regression constant, and B is the multiplier, we call it beta, and E is the error term. Because not always this P equals to A plus B times S. Sometimes there could be discrepancy, and the E stands for that discrepancy. Okay, and S here is the exchange rates. It can go anywhere, and the value, the dollar value of the firm can also go anywhere. Previously, we focused on the cash flows because we were focusing on the market value system. Right now, let's focus on the assets value. Let's focus on the book value system. So the beta is taking this formula, and that's the covariance between the book value in dollar terms of the firm and these exchange rates divided by the variance of the exchange rates. All right. You can keep exploring the beta's formula. So basically, if you try to find the covariance, this is the steps you can take, and it can be further expanded like here. And well, I do not want you to calculate based on the formula. I just put it here to scare you. So you don't have to do this. All right. So if you don't want to do it, you better learn the method that I'm about to teach you. Okay. So right here, I'll give you an example. Suppose a U.S. firm has assets in France whose local currency price is random. Okay, for simplicity, suppose there are only 3 states of the world, and each state is equally likely to occur. So they each come with a 1/3 probability. And the future local currency price of these French assets, as well as the future exchange rate, will be determined depending on the realized state of the world. All right, so we have 3 cases. We're going to analyze it separately for each case. Let's just look at the first case. Okay, so in the first case, you have 3 scenarios. Okay, 3 scenarios. They each come with 1/3 probability. 3 1/3 added together is 100% or 1. And in the first scenario, in case 1, the French assets is worth 980 euros, and in that scenario, the exchange rate is 1.40. Okay, and based on this euro assets value and the exchange rate, you can get the dollar value of the assets. Okay, for scenario 1. And in scenario 2, the euro value of the assets is 1,000 euros, and the exchange rate is $1.5 per euro. So you do the multiplication, you get the dollar value. And you do the same thing for scenario 3. Okay, so that's your dollar value of the assets. All right, you do the same thing for case 2 and case 3. So there's nothing complicated about it. But if you want to get the economic exposure, okay, which is the beta right here in your formula, you see this is the dollar value we just calculated in the column, and this is the exchange rate. Okay, so we're about to estimate based on 3 scenarios, and try to find out the beta. And you're welcome to do this. Okay, calculate the covariance divided by the variance, and use this giant demonstrative formula. Okay.